We're going to talk all about things like that now with Emily Roland joining us now as we get, it's May 1st. John Hancock, Investment Management, Co-Chief Investment Strategist. Emily, you're kind of optimistic, or at least calm, because in your view, non-U.S. assets, if they rally, that should be sold. And you make some really interesting points that if you, and this is what we've been saying, if you just pay attention to what's right in front of you, you've missed a lot of move. And the cross-asset leadership that we've seen is totally at odds with what you hear, fundamentals, and what the media is saying.
Yeah, Joe, it's really remarkable to look at U.S. earnings coming in around 10%. Meanwhile, you look at EFA and earnings are coming in at negative 9%. You look on the economic front, PMIs are accelerating in the U.S. or at least beating estimates while they're rolling over in Europe. The European Economic Surprise Index is moving lower while it's improving in the U.S. And meanwhile, European assets haven't even flinched in the face of this. Europe's outperforming the S&P 500 by 20% year to date. It's really quite remarkable. Meanwhile, we've seen sort of the baby thrown out with the bathwater, where U.S. high quality assets have been sort of selling them as been the tariff playbook. That doesn't make a ton of sense to us. And we're seeing some value open up in that part of the capital markets.
We've talked before about how the investment strategist, the co-chief investment strategist of an insurance company might have a different sort of a risk profile than just a straight equity asset manager. So talk about bonds. Would you say the same thing has happened there in terms of what we were expecting and what's happened? I mean, we had a brief head fake back to 440 and people were worried on the 10-year, and people were worried about 5%, I guess. And here we are at 415 today. That hasn't happened either.
Yeah, we would look at every backup in bond yields here as a gift, because I know everybody's so myopically focused on the potential inflationary impact of tariffs. But there's another story brewing underneath the surface where there's significant disinflation going on. Oil prices are now below 60. We're seeing the potential for demand destruction in the face of some of these political developments. And then we're seeing massive changes within the housing market as supply is finally starting to loosen up. I know everybody locked those low mortgage rates in. That was 5 years ago. Things happen. There's now more movement. People have to move. Other life changes happen. We're also seeing demand slowing as unaffordability remains an issue. Insurance costs are elevated. The sentiment surveys are telling us that folks are concerned about their jobs, are probably not going to make a big purchase. If housing or shelter inflation can come down, overall inflation can come down. That means bond yields lower and elevated total return potential in fixed income today.
Jeez. So are you pushing out the end of the world to beyond 2025?
So
Emily?
it's a facts versus feelings thing, Joe. Like, markets are completely trading on sentiment and feelings right now. And that's why you've seen this massive rotation out of the U.S., whether it's a lack of confidence or political angst or broad uncertainty. But you have to look at the facts. U.S. earnings growth coming in or penciled in for 10% this year. Again, initial claims at low 200,000. So there's really not a ton of cracks in the labor market. We're seeing inflation come down. The Fed cut to end the year. Again, oil prices lower. So if you look at the facts, it's a very different picture than what the feelings are telling us. And we want to invest based on facts, not necessarily based on feelings. We would look to redeploy assets into U.S. stocks. I know Becky's at the shareholder meeting. You know, Warren Buffett said a few years ago, you know, never bet against America. And we really agree with that narrative.
With the deregulation, and I don't know what happens with, you know, maybe there's some concern about the deficit implications of this big, beautiful bill. Maybe that's a problem. But there's a lot of things that were positive, and the one fly in the ointment was tariffs. And now we're hearing, I don't know, we heard from one of the administration officials that the administration would like to get to a point where there's a handful of bad actors that get the brunt end of the trade war and of the tariffs, and that everybody else eventually it's going to be eased, or, you know, maybe China's still there, or maybe not. Apparently, maybe China is. You know, now we're approaching China. We'll see. We're going to have Kevin Hassett on a little bit later. But if you remove the whole tariff issue, and then you add in everything else that you just said, then I don't know what bears are going to have to hang their hat on at that point. They just better throw in the towel.
Yeah, right? There's definitely opportunity.
Recession.
And then to your point,
worries.
yes, deregulation, tax cuts, there may be some positive elements coming down the pipeline here that we don't want to forget about.
Okay.